Welcome back to another great podcast episode here at the Investors Row, where we always talk about all things alternative related. Your host here, Ramesh Fakori, VP here at the IRA Club. One thing that we always focus on here, and in the past, better yet, is real estate opportunities. Real estate has been such a big part of alternative investments, especially within your retirement account. In the past, I talked a lot about multifamily, mixed use, commercial. Also talked a lot about why you should be incorporating this, but we haven't really talked too much about turnkey investments. And today, before we even jump in and introduce my co-host for the day, Jason, I want to talk about this sector, all right, and in particular, hard tangible assets, real estate, turnkey, and the terminology behind it, and why you may want to consider utilizing this. So joining me today, again, mention your name, Jason, is the founder and CEO of Freaky Fast, the Freaky Fast Group. I love the name, by the way, Jason. I want to learn more about you. I know your story. I met you a couple times in the past at events where we sat down, had a great, glass of bourbon and just kind of shoot the shit, as we like to say in our space. But tell me, why real estate? How did you get involved? And your story, by the way, makes me laugh every time I hear it. I want you to kind of give a quick, 2-3 minute intro.
Sure. So grew up in a pastor's home and always had a knack for sales and for business, but always had ministry kind of really the calling. And my mother passed away of cancer, and so I
Sorry.
just kind of got out of like doing ministry work at the time and just really kind of focused on business. And met my wife. She's a country artist, Tori Martin. Selfish plug there. So if you guys like country music, check her out. Her song is doing quite well on country radio right now. Cowgirls Ride. So make sure to take a listen to that.
Jason, didn't you just win a big award, by the way, not too long ago?
She did, yeah. Female Vocalist of the Year, or New Female Vocalist of the Year for Texas.
Congrats. Tell her congrats.
Thank you. Yeah, thank you. So we moved to Nashville, and I was just looking for work, just wanted to do something a little bit different, and I opened up Craigslist, found an ad on Craigslist for an acquisitions company that did wholesaling. Knew nothing really about real estate or the investment. I watched HGTV like everyone else and saw Chip and Joanna Gaines doing their thing, but really didn't know how to get involved. So I applied for this job, literally harassed them until they gave me an interview, and they taught me the wholesaling game. After about 6 or 7 months, they ended up going to a different state. And so I was kind of just stuck thinking, okay, I got to figure out how to make some money. We were dead broke. I got bills coming up. So I wrote out handwritten letters saying we buy houses with cash and, give us a call. And my wife likes to brag that she was my first investor because it was her $20 that we used to buy 40 stamps. And I prayed over those letters before we mailed them out. I was like, God, I got bills. I need to get a deal. And 2 days later, got a call and got my first wholesale deal that I did on my own. That was mine. That just kind of launched our company. So I did wholesaling for about a year and a half and had an opportunity to buy 18 rental properties in Columbus, Georgia. And so that was my first opportunity to kind of move into that sector. So we closed on those, and from there, Freaky Fast Home Buyers and Investments was born, and it's just really taken off. So the last 6 years, we have acquired over $45 million in assets, most of that primarily being single-family homes in 7 states. And I appreciate you liking the name Freaky Fast.
Yeah, I was like,
some guys.
Where'd you come up with that name? Because I was thinking like Jimmy John's for a split second when I first heard.
Well, it's funny because so many wholesalers use the word quick. So like Tennessee Quick Home Buyers, Nashville Quick Home Buyers. We buy houses quick in Ohio, so they always use the word quick because basically you're marketing to people that are in bad spots. Maybe they inherited a house that they need to get rid of. Maybe, they got to move really quickly. And so they don't have time to put it on the market. They need to sell their house quick. But I didn't want to be quick. I wanted a different word because so many people were using that. So I said, well, let's do something with fast. And then it's like, well, how fast? And then it's like freaky fast. And it's like, oh, that's kind of cool marketing. So we did it and it worked really well. And so that's just kind of become our brand. So, you'll get some people like, I don't really like that name. And then you explain it to them. It's like, oh, okay, that makes a lot more sense. And then once the name sticks, it's really hard to change it. So we buy houses freaky fast. We do investments freaky fast. That's just kind of our motto here.
Yeah, so I know you're really big on education, just like me. We talk a lot about that here on the podcast. And we always talk about generational wealth. I always like telling
Yeah.
people, I understand the majority of your 401ks, IRAs, all your qualified retirement accounts that are out there sit, within the stock market, right? Stocks, bonds, mutual funds, ETFs. And when I tell people historically, right, when I just said earlier, 90% of millionaires incorporate alternative assets, but in particular, real estate assets. Now, when we talk about the S&P 500, gives you about a 300 in the past 20 years, about 326% returns on your money. But when you incorporate real estate into that equation, it's a 2100% returns on your money. So what I'm trying to say is, I always tell Jason, isn't it important for you to think as an investor, not only to use your personal dollars, but your retirement dollars in the same manner? And just most people don't understand that you can do that. So with that being said, you and I have quite a few clients that we work collectively together.
Sure.
When we help educate them, what when you think of the term turnkey, what is the best acronym? Like, if you were to break it down, why turnkey? Why did you focus on that specific type of investment opportunity within real estate? And maybe later on, we talk about how an IRA or 401k can incorporate that inside their portfolios. So why turnkey? If you were to break
Yeah.
down the terminology.
Yeah, great question. So first of all, turnkey definition means that you're buying this house fully rehabbed and fully creating cash flow. So it's been rehabbed. It's got a tenant in the property that's paying rent. It's currently cash flowing. So you're
Mhm,
walking into a full turnkey model. So you're not doing any work. The reason why turnkey is because we want to create passive income.
mhm,
We've all read Rich Dad Poor Dad. We've all been to the conferences. We've all listened to the podcasts. We've all read the articles about real estate and how, like you mentioned, 90% of millionaires have been created by real estate. And so we understand that game, or we think we understand that game. Then we
mhm.
get into real estate knowing this is an investment vertical or strategy that we need to be doing, only to find out that it's not truly passive. It is very active. Whether you're trying to identify the properties, you're trying to rehab the properties, you got to get them rented. Like, it's a lot of work. And so
Work,
what
yep.
happens is you get investors who are wanting to put capital to work for them in a passive format, and they go into the real estate game trying to do it themselves and then realize, holy crap, what did I just get myself into?
Yeah.
This is a second job, a third job, a fourth job. And so doing a full turnkey investment allows you to do the real estate, but do it more from a truly passive route. So that's why turnkey.
So are the majority of your turnkeys, are they acquisitions where you take them, fix them, and then put the tenant in? Or is it more so new construction? Or is it a little bit of both?
Yeah, so for our rental properties, we don't do new construction.
Okay.
We do new construction deals, but those are more for first time home buyers. We're putting those on the market, and even then, we don't do a whole lot of those. Our bread and butter is finding good properties that we can go in, rehab them, add value to them. They make great rental properties, and get those cash flowing and paying out dividends.
And that's the
So
key.
that's really
That's the
yeah,
key, Jason, right?
yep,
Cash flow. That's what we do. Cash flow is always king. So market, right, as it drops up and down, the volatility of the market now has been crazy since, Trump took office. We don't know what
yep,
he's going to say that's going to hinder that. But with that being said, that's what we believe in, Jason and I. Okay. At the end of the day, is cash flow is always going to be king. But, we never talk about, future performance versus past performance.
sure.
Your investors typically in the past, let's say 10 years, right? You said, what kind of returns have you seen
Yeah, great.
when you incorporate, forgive me, appreciation versus the actual rental income?
Sure. Yeah, it's a great question. So I remember talking to an investor last year, a potential investor, and
Mhm.
they're like, why should we invest with you? Like right now, the stock market is doing historic highs. It's my portfolio is doing over 22%, and why should I invest into real estate and alternative deals when the rental cash flow is only doing 8 to 10%? And it's like, okay, you're looking at it completely wrong. For example, stock market is just positions.
Mhm.
So if it goes up, then that's a position. If it goes down, it's just a position. It's not a profit or loss until you sell that
Sell.
position. So the difference for what we do versus the stock market is like not only do you own this position, but this position is cash flowing. So you're getting dividend checks. There are some stocks that pay dividends, but
Mhm.
that's not a lot of them do. Most of them don't. So you're buying a tangible asset that will cash flow that also grows in value, which is just like the stock market. That's a position that's growing that you don't fully realize until you sell that house. And, so after I explained that to him, I was like, look, your stock portfolio did about 22%. Ours did almost 41%. And it's because we gave 10% in cash flow, but then those properties grew 30% in the first year. And then in addition to that, without even counting that, you get depreciation as well that you can write off on your against your passive income. So you're putting more money in your pocket. And I think a lot of people just don't fully understand that. They just kind of see the numbers on their, Charles Schwab account or,
Yeah.
Fidelity account going up. Hey, it's in the green, or, my Robinhood account, it's red one day and green the next day. And so they just kind of see that. And they don't really fully understand or realize that that's just equity on paper, just like appreciation is in a home. But then the homes create cash flow. The second thing that's great about real estate versus like the stock market
Mhm.
is that house is not based off of a P&L of some company that I invest in. So if they have a bad third quarter, those stocks can go down. This house will continue growing in value. I got so many facts I could just spitball on that, but this is my
Oh,
favorite one, and then I'll turn it
well
back
done.
over to you.
Mm.
You can tell I come from a preacher's family, just
Yeah.
rattling and talking. But in 1983, the average house price was $70,000.
Mhm.
40 years later, 2023, it was over $380,000 was the average. It grew over 400% over that 30 years. And it outpaced inflation, outpaced um, the devalue of the dollar as it continued to go down. That value of that house just continued to go up. And that's not counting any of the cash flow that you received over that 40 years. That's not counting any of the depreciation that you received over that 40 years. And so real estate is just a great way to invest, to grow your wealth, but then to build generational wealth
J
for your family.
Jason, what most people don't realize is I always tell when I have this conversation is, you know what asset class we always say is never lost money ever? And don't forget about the 2008 crash. So someone's gonna
Sure.
say real estate. I always say, no, no, don't forget about the 2008 crash. Rental income. Rental income only really goes in one direction, and that's up. It may plateau, but you'll never see it go down. And there's for a lot of factors that play into that. Now, one of the things I do want to follow back on something that you said is what states do you actually focus on? Because I personally, you know this, I already had this conversation with you. I own 16 residential units. A big majority of that is in the Chicagoland area. I hate being a landlord in Chicago. I know you're
Sure.
laughing, but I do have a couple units in Indianapolis, and they're so much easier to deal with. So, with that being said, is there a reasons why? What states, first of all, do you primarily focus on, and what are the reasons why behind it?
Yeah, great question. So, right now we're primarily in the Midwest and the Southeast. The Southeast was really, really hot a few years ago. You had just a lot of investment capital going into the Southeast. Now you're seeing that going into the Midwest.
Mhm.
So we're in Ohio, Indiana. We're in Kentucky, Tennessee, Georgia, Florida, and Texas.
Reasons why?
They're great for being landlords.
Yep, landlord friendly.
They're very landlord friendly. So that definitely helps. But really it's more about a few different things. It's more about the value of your dollar. I've had some people say, "Why don't you do more investing in Fort Worth where your office is?" It's like, well, for the amount that I could buy a house in Fort Worth, I could buy 3 in Ohio, and they're gonna cash flow better, the property taxes aren't as high. So, some people I think are focused, and everyone's got their own niche. Everyone's
Yeah.
got their own formula, their own strategy of what they're trying to do. For us, it's yeah, appreciation is important, but also that cash flow, that yield is very important as well. And, some people are okay making 4 or 5% on the rental properties because they're banking on the appreciation over 10, 20 years. For us, we're being more aggressive. We want that 8 to 12% in cash flow, and then also seeing that appreciation. So we've got our kind of niche, our strategies, and they've worked very, very well.
The other thing is sometimes I see a lot of people also focusing on when picking and where to invest their dollars is growth. I would never, full disclosure, if you're new to the investing world, I'm not a fan of Chicago. I'm not a fan of New York. I'm not a fan of anything in California. Um, those are declining populations, as we have well seen, Jason. People are. I really do try to tell people look at second tier cities, is which I think what you're focused on at the end of the day.
Yep.
The other thing that I also wanted to add is, outside of the turnkey investments, you guys offer. Do you guys offer any other opportunities currently outside of just turnkey investments?
Yeah, so, like, the way that we structure some of our deals right now is
Yeah.
we allow investors to come in and actually partake on the rehab side of things as well.
Nice.
Because a lot of investors, they want that equity growth quickly, but yet they don't have the time to rehab it. They don't know how to rehab it.
Yep.
They don't have the teams to rehab it. So again, our strategy at Freaky Fast is we want to create passive investments, but allow you to partake in active. So what we've done is we've created ways to blend those two together, so that you get the upside of rehabbing and adding equity right out of the gate,
Mhm.
along with turnkey that's cash flowing right out of the gate. That way money's not sitting, because at the end of the day, when money's sitting, you're losing. So, we wanna get that money working as quickly as possible. Now, I get it, if you're putting it into a house to build that immediate equity, there's gonna be downtime, but it's like if you can navigate and blend to where there's also cash flow coming in, it's the best of both worlds.
Jason, I love that you said that, by the way. You don't want to do the work. All right. I guarantee you, you don't want to do the work. I call that tuition. Okay.
Yeah,
Because you will not know what to do, especially if it's your first time. It's always good to go with a company like Freaky Fast that will kind of help guide you through that element. But also keep in mind, if you are using your retirement dollars, because that's what we preach at the end of the day. Jason mentioned the word active. You're not actively managing the property, you're investing into the fund. Correct me if I'm wrong, Jason.
correct.
So that's huge because when you use retirement dollars, it has to be 100% passive at the end of the day. So let's walk through that process, Jason, because maybe somebody doesn't understand. Like, so just say somebody wants to invest with Freaky Fast, and they
Yeah,
want to use their retirement dollars because that's what a lot of this podcast does focus on. Somebody has an old account, let's say with Fidelity, Vanguard, Schwab. They want to roll over a portion of an old employer 401k over to the IRA club. Remember, it's not you that's investing, it's your retirement dollar that's investing, right? So if it is a turnkey investment, the titling of it is going to go, let's say, for example, IRA Club, FBO, and the benefit of your first name, last name, and your IRA account number. That is where you get the tax benefits at the end of the day. I had a person the other day told me, well, why would I want to jump on a turnkey investment when I can't do the depreciation factor of it? I get it, but we're talking about diversification at the end of the day, right? Um, and here's the icing on the cake. You never pay taxes to begin with, anyways, within your retirement account. That's what I try to explain to people. And they forget it's not just the federal tax rate, it's all taxes across the board get wiped out. So, Uncle Sam's going to take about 30 to 40% of what you make when you purchase that house. And I understand there's going to be some years where you can take that depreciation. But when you look at it long term, because when you buy real estate in your IRA or 401k, it's the long play, right? You're going to hold on to it for probably well over a decade. And it's going to generate you cash flow back to your retirement account. So it doesn't go to you, to be clear, it goes back to your retirement account. Now, Jason, your fund that you talked about, if somebody, and I'm assuming, do you offer a dividend within the fund?
Correct. Yeah. So we pay out monthly distribution.
Monthly distribution. So if somebody, for example, wants to use their retirement dollars, and can that money can it be reallocated back into the fund
It
instead
can.
of sitting back in their IRA club
Correct.
account, for example?
Correct.
It
Yep.
can
It
be
can.
awesome.
Yep. But then also, I think if I'm not mistaken, you guys got a pretty cool project that you're working on. Can I give you a selfish plug or?
Please, if you're more than
Yeah,
welcome.
so
Thank you.
I love what you guys are doing. What is it? iFund or something like that? iFlip or
Yeah,
um,
yeah, I flip. So yeah, in a previous podcast, we talked about our AI trading platform. See, Jason, me and you talked a little bit about, the downturns of the market and whatnot. But at the end of the day, we don't have a problem with the stock market. It's not that we don't believe in it, right? The positives about having money in the market is it's liquid. You could sell it anytime you want if you need access to it. But at the end of the day, we believe you can't touch the money within your retirement account until you're 59 and a half. So it's like, why not use it, right? And why not diversify it?
yep,
Because there's certain things that you could not do outside of just stocks, bonds, mutual funds, and ETFs um, within your retirement account. And for example, the plug that Jason was trying to say is if you are buying, for example, a house on 123 Green Street, and you are getting that cash flow back to your IRA or 401k, you can shift that over to our AI trading platform, and that can accelerate it for you. We never want your money to sit at the end of the day. So thank you for that selfish
yeah.
plug and
Well,
leading me into it.
and if I could just add to that, so basically, what we kind of preach to our investors is you obviously want to be diversified, but you
Yep.
should have buckets, and you should have those buckets set up for different goals. And then the other thing is, you need to know your destination. It's hard to achieve anything if you don't know where you're going. And so it's like, what are your goals for you and your portfolio? Are you just literally wanting to, make it? Are you just wanting to be able to have a comfortable retirement? Or are you, very successful in business, or you've had or currently have a great income and you're building up this retirement. It's like, okay, now I want to multiply. I want to add. I got goals. I want to travel. I want to give back to church or charity. And, I really want to make a difference in my kid's life. So it's like, what is your goal? And so then that way we can help reverse engineer it. So for example, you should have, certain capital in the stock market
Mhm.
that is generating money for you and returns for you. That's easy to access for whatever emergency that you might have, or for whatever maybe cool opportunity that's come up that you need cash quick. Instead of that cash just sitting in the bank, have it, in the market
Yep.
generating income for you. But if you're using your IRAs and your 401ks and you've got money that you could put into alternative investments that's going to see much greater growth, and bigger growth and the opportunity to give multiples, then you should really take advantage of that so that you can start building. So I like to tell investors they should have four buckets, for their retirement. They have the bucket that replaces their income.
Mhm.
They've got the second bucket that's for their health. The third bucket is for leisure. So I want to travel. I want to, go enjoy the world. And then the fourth bucket is money that you want to give. It's a charity. It's what you're wanting to give back. And within those four buckets, you're just growing and you're building so that you can enjoy your retirement life. And not just like survive it, but actually thrive
Drive.
in it.
Yep. Jason, I always call that the second mountain, like the second part of your life. And I love how you said reverse engineer that. I want to ask you a question. I have a lot of clients, right? That when they look at turnkey investments within their retirement account, they feel like they're being it's been outpriced, right? It's not what we remember from just 10 years ago. COVID has drastically jumped those numbers up. What is the average when you're investing in these, the second tier cities that we just talked about? What is the average cost of a home these days, especially when you're investing? Where you're investing, please forgive me.
Yeah, yeah. So it depends. If you're buying them full market value, you're buying them between 120 and
Okay.
250 normally.
So
We're
obtainable is what I'm saying within an IRA or 401k
for sure,
for sure.
absolutely.
So the
Yep.
one strategy that I always teach people is it's always good to buy the house outright within your IRA or 401k because you don't want to you want to offset. It's called UDFI, unrelated debt finance income tax. Most people don't realize that you can use your retirement dollars and your personal dollars, and you could partner that money to buy the asset outright. That is a powerful strategy, or most people don't realize you could use multiple retirement accounts. You could have a traditional IRA and a Roth IRA and partner that, or you could partner with your spouse or your friends or your children. So that is a possibility. And according to you, 120 to 200, a little bit over, is definitely achievable within a retirement account. So that's a really big deal. I always say, Jason, I always like when I have a conversation with you, you're always thinking ahead. So what's next for Freaky Fast? Like, what's the next move for you guys? What are you guys working on?
No, we're always working on something. There's not a day that goes by where we don't have, some idea. But we're actually doing a couple different things. We are doing a private equity investment strategy where we're buying HVAC companies. One of the reasons for that is because every one of my houses needs HVACs. And so it's like, why buy HVAC from somebody else? I should be buying it from myself. And so we're doing that opportunity. Another opportunity that we're looking at, we're doing our first commercial deal. It's going to be a gas station, and I'm extremely excited
Nice.
about that. Yeah, and the main reason for that is because a lot of our investors need tax write-offs, and they have a lot of uh, tax liability coming up or tax events coming up. And so we're creating this. Now, what's exciting about that, though, is if I may just throw in a strategy that we recommend
Please,
for our IRA investors.
please.
I'm a firm believer of having your money in a Roth. And the reason for that is because that Roth is tax free. So any income coming in is tax free.
Mhm.
So it is tax free in your traditional until you pull it out. Once you pull it out, you got to pay taxes on it. So it's like, why don't we go ahead and somehow figure out a way to get that money into a Roth? Well, the problem with that is two things. One, only certain people qualify for a Roth, and that's usually how much you make per year. And then the second thing is you can only contribute up. I think it's like 7,200 or 7,500 a year now. Do you know
Se-
what?
Seven, and if
Oh,
7,000 if you're under the age of 50, 8,000 if you're over the age of 50.
got it. Okay, so so that there's only so much you could do with that,
Yep.
right? However, there's another strategy that a lot of investors either A, don't know about, or two, or B, their CPA is like, oh, don't do that. And that's what we call is backdoor conversion. I know you're very familiar with that.
Yes, I am.
And so you're moving your money from your traditional to your Roth,
Correct.
do a backdoor conversion. Well, what happens is you have a tax event immediately when you do that. And depending on what bracket you're in is what you're going to pay on that amount that you move over. So for
Mhm.
example, if you move 100 from your traditional to your Roth and you're in the 37% tax bracket, you're going to pay 37% of that 100 grand into, or you're going to pay taxes.
Yep.
So a lot of people are like, well, why would I do that? Well, because number one, let's just say that 100,000 now makes 300,000. That $200,000 gain, you don't pay any taxes on. And I've seen it to where Ross will 10, 20x, depending on what type of investments they got into, that they don't pay any taxes on. So the idea is how can we figure out a way to offset the tax event that you're going to receive when you move your money over from your traditional to your Roth? So if you've got liquid capital, you can invest it into a investment strategy that's going to provide you a massive tax loss that you can then use to offset that backdoor conversion tax event that you're now going to receive. So now you just literally moved money into your Roth pretty much for free. And now all that money that you make in that Roth is tax
Moving
free.
forward. Yep.
That is how you build generational wealth. And, the wealthy people do it all the time. And it's like these are just rules to games that are available for anybody and everybody that wants to play and it's there for you, for the taking. So it's like take advantage of it. So we are creating this particular investment for people who need tax write-offs, or two people who would like or need a tax write-off because they want to move money over to a Roth.
Well, listen, I'm a huge advocate of talking to each other, networking, you know, talking these types of strategies. If Jason, if it's okay with you, or one of your colleagues, I know you got a big team over there. If we could just plug in maybe a hyperlink where somebody could schedule a call, would that be okay with you?
Yeah, absolutely. Well,
Love
we'll
it.
definitely love that.
Love it. And I highly, highly encourage those that are listening. This strategy is pretty cool. I'm very familiar with it. Jason actually incorporates it as part of the conversation when utilizing retirement dollars. He's a huge, huge advocate of Roth accounts, just as we are here at the IRA Club. It's all about how to avoid Uncle Sam at the end of the day and how to make it grow, as he mentioned, generational wealth. That's what it's all about at the end of the day. Now, one thing I do want to touch on before if we want to learn more about Freaky Fast and where to find you is you talked a lot about the positives within turnkey investments, right? When I tell people before you jump into any investment opportunity, because I could never choose the investment for the investor, this is the whole purpose of why we created the Investors Row podcast, is to bring in resident experts like you to talk about it. um, Talk to me a little about if somebody wants to do a little bit more due diligence, like what is some of the risks that you see when investing in turnkey? We talked a lot about the positives. Give me some negatives, things to be aware of.
Well, I think let's step back from even just the turnkey. Let's just talk real estate for a
Love
second.
it.
Real estate is probably the most safest investments you can make because they're tangible assets. I mean, there's a lot of great alternative strategies out there, but at the end of the day, there's always risk because it is an investment. Like you can't guarantee anything. You can't take out risk 100% because life is risk, right? You see a beautiful girl, you want to ask her out on a date, you're going to take that chance of her saying no. Like that is a risk, right? Like it is what it is. You could be the best looking guy and you can go to the gym and work out and just try to take out the risk of her saying no because of how great you look. But she could still say no. She may like short, fat, bald head guys. You just never
You
know what
never know. You never
exactly.
know.
So there's always risk. And I joke, but I use that as an example of it. You could do all the due diligence in the world. It
Mhm.
doesn't mean that it's still going to be perfect. But here's what I would say is this. Here's why I think single family is where people should be investing right now. You're seeing multifamily really, really struggling.
Mhm.
And yet multifamily is kind of what is promoted as the best way to invest passively.
Mhm.
Why? Because single family, it takes a lot of hard work to actually gain the wealth that you want to do in single family. You need many, many units, and it's easier to scale units in multifamily. But here's where people are struggling right now. Interest rates are affecting everybody,
Mhm.
but it's really hitting the multifamily sector very
Hard.
bad right now
Mhm.
because these are all commercial loans that are 5-year loans.
Correct.
So projections that were based in performas did not project interest rates being as high as they are. And and so therefore, we're seeing distributions not getting paid. We're seeing maybe potentially multifamily unit complexes going into foreclosure. So why single family? So here's why I'm saying all this. Single family is a 30-year mortgage. You can literally allow the tenants to pay down that rent, or excuse me, that rent, pay down that
The
mortgage,
mortgage, yeah.
creating more instant equity for you. That house is not going to devalue because of cap rates. The value is based off properties within a 2-mile radius of like size and specs and what that price sold for. That's what holds the value of that home. So when you're doing your due diligence, not too many people ever see a bad performa. Like no one's going to put out a bad performa. Like they're always going to look great. Sometimes you have to look within to see the strategy. So what's the negatives with rental properties? Well, you could have tenants not pay. You're going to have to evict. And so now there's a few months of no cash flow. Are you
Mhm.
set up to, keep that from really affecting you? Are you able to pay your mortgage if you're putting a mortgage on it? If you're doing it through an IRA, then you like you recommended, buy it out, right? That's not going to affect you as bad.
Yep.
But if you invest into a multifamily that's going to get foreclosed on, well, now you're in
You
a
lose it.
little exactly. So there's different risk, and I'm not saying that multifamily is bad.
Yep.
I'm a firm believer in multifamily, but it's just understanding the markets, doing your due diligence in the market more than it is in the deal. The other thing too is doing it with the person that you're investing with. And believe me,
Skin in the game, yep.
Yep, an operator is not perfect. If they tell you they're perfect, then they're lying. Like, we've made mistakes. We continue to make mistakes. But we really strive to do the best that we possibly can to be a good steward. One of our core values is responsibility. If we screw up, we take responsibility for it. Um, And so trying to eliminate and really just do good deals that you possibly can. So as you're doing your due diligence, a lot of times it's more about the markets and 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 then the operator. But even then, the operator can't control the market, so they could be the best operator in the world, and
Something
something
horrific.
happen,
Yeah, something happens. COVID, for
and you just
example.
can't
Yeah.
control it.
Yeah.
So
At the end of the day, I always tell people when listening, educate yourself first, right? See what your surroundings, what allows for what to happen will dictate the way I'm going to invest. And at the end of the day, you want to take educated, calculated risks, right? That's the focus of why you do alternative investments. You talked a lot about turnkey. The reasons why we do like a portion of your retirement dollars and a hard, tangible asset is nobody could take that away from you. I mean, the worst thing that could possibly happen is the house burns down. Well, guess what you have that protects the retirement account? Insurance. When you lose, for example, 30-40% in the market, doesn't take days, it doesn't take months, it takes sometimes years. A lot of us do remember that 2008 crash. In fact, let's just talk about the COVID, right? At 2020, the end of 2021, 2022 individuals lost almost 23% within their 401ks. It took 1.8 years to get back to that break-even point. And now markets, again, are a little bit volatile. But at the end of the day, hard tangible assets, a portion of that within your retirement account, you should consider, because nothing could happen to that money at the end of the day. It's yours. The asset is out and it's yours. So, Jason, people want to learn more about Freaky Fast, right? Where can they find you?
yeah, freakyfastinvestments.com. That simple. Freakyfastinvestments.com.
FreakyFastInvestments.com. So,
Yep.
what I will promise all our listeners is a consultation link. We're going to make sure that you could schedule a call, learn some about more strategies, learn more about your company, learn more about Freaky Fast, the company, and then balls in your court, right? This is how we always look at things. Our job is to educate you first and foremost and take it to the next step. Want to learn more about us, IRA Club, please visit us at iraclub.com. Follow us for the Investors Row podcast, IRA Club /podcast. And if you do so, I promise that I will give you Dennis's latest book. Jason, I don't know if you know this, but Dennis is the author of 17 books. This is his
Oh,
latest
wow.
one, Money Making Ideas Within Your IRA or 401k, 15 Ways to Increase Returns, Reduce Risk, and Save on Taxes. Jason, it is always a pleasure, my good friend.
Absolutely.
Please see you at the next event.
Yeah.
I think I bump into you at more events than anybody else recently. But till next time, guys, thanks, Jason, for jumping on.
Graham, thank you so much. I appreciate the opportunity. And I guess if I could just end it with this, now is a great time to invest. Get into the game and we'll watch and see what happens.
Never too late.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.